80%. April 4th, 2014, it happened again. Another X formed as the red line shot straight up and the green line fell. And look what happened next. WWE dropped like a ton of bricks. However, if you had simply bought this stock at the first X and sold when you saw the second X, your reward would have been a 180% windfall in about 6.5 months. Let's jump back to 2009. You'll see the same story play out with Netflix. On August 7th, the green line shot straight up as the red line dramatically fell. The first X was formed. And then, almost 2 years later to the day, on August 5th, 2011, after Netflix's stock had jumped 420%, the red line shot straight up as the green line fell, and they crossed. The second X appeared. And over the months that followed, Netflix stock crashed 65%, wiping out the majority of the gains. From boosting subscriber counts and increased revenues to overhype and rising costs of securing content, there was no shortage of factors driving Netflix's wild ride. But none of this matters, because by grabbing shares of Netflix when you saw that first X and selling at the second X, that 420% winner would have been yours for the taking. Let's rewind back even further to the year 2000. Here's a chart for the agricultural products company American Vanguard Corp., ticker AVD. And what do you see March 16, 2000? That green line shooting straight up as the red line falls. And there's the first X. At the time, American Vanguard stock was trading for $1 a share. And when the second X appeared on July 31, 2007, it had hit $12.25 a share, representing a gain of 1,125%. From a major deal with DuPont to a series of consecutive jumps in net income, somebody looking back could have provided a long list of reasons for American Vanguard's multi-year rise. However, my goal is to prove to you that none of them matter. Because before any of these things came to pass, that first X had appeared. And if you had bought all the shares you could get your hand on when it did, then sold them when that second X arrived, you would have pocketed that 1,125%. And you would have been free and clear when shortly afterwards, American Vanguard stock dropped 43% to only $7 a share. These three examples represent a quick snapshot of something amazing I have discovered. It's going to change how you invest from this day forward. Now, we all know that investing carries risk. However, after conducting a 6-month investigation that involved a treasure trove of research and extensive backtesting into winning trades, my team and I were simply stunned when we uncovered this. For the last decade and a half, the last 15 years, this first X pattern has appeared in 2 to 3 stocks a month, each and every month. And during this time, if you were to just buy regular shares of those stocks when it did, then sell when the second X arrived, you could have been rewarded with a constant stream of high triple-digit winners, even gains that soared well beyond 1,000%. I spent more than 33 years in the markets as an analyst, consultant, and quantitative trader. From my work at some of Wall Street's biggest firms, including Wilshire Associates, which oversees more than $8 trillion for over 600 institutional investors, to my role here as Money Morning's chief investment strategist. My expertise is in identifying market patterns that others don't see and in finding opportunities that are, as of yet, unrecognized. Which is why I've been a consultant for international economic think tanks and am a frequent guest on major media outlets, including Fox Business, CNBC, Bloomberg, CCTV, and more. They call on me to use my findings to predict the major trends and to identify where the biggest opportunities will emerge from them. Well, this X pattern is frankly the biggest opportunity I've ever come across. So when I discovered it 6 months back, I set out to verify that this extensive market data was indeed telling me what it appeared to be. And no matter how many times I ran through this information, no matter how many times I had my team try to find an exception to the rule, we couldn't. In fact, we always got the same answer. From the bursting of the dot-com bubble to the recession and the bull markets in between and after, amazingly, throughout all of this immense market turbulence, all 15 years of it, there was a constant, one that stayed hidden until very recently, this X pattern. Look at your screen. Look at what's happening when that X forms. Shortly after, oftentimes within 24 to 48 hours, the stock shoots up. Now, look at these charts. What else do you see? There's a second X pattern, and focus on what happens after it appears. The stock begins to pull back. By nailing this time frame, By simply buying when you saw the first X, then selling when the second X appeared, you would have won on 100% of these trades. You would have never lost. More importantly, you would have had the opportunity to take part in some of the biggest windfalls in recent history, like 2,941% on Terra Nitrogen, 7,476% on Monster Beverage Corp., 2,566% on King Gold Jewelry Inc., 1,478% on Radcom Limited, and 1,328% on U.S. Global Investors. Which is why I am so very excited to be going public with my findings today. Ahead, I'm going to explain what these X's represent, which stocks they'll appear alongside, how easy it is to spot them when they do, and I'm going to reveal why we're putting $1,895,000 on the line. I'm going to lay out all my proof so you can decide for yourself, because I'm confident that in a few minutes, you'll be able to use the same X pattern to only buy stocks that are going up. Remarkably, once you pull back the curtain, the secret behind the X is something we were all taught in high school. It's just basic physics. Think about it this way. Imagine you're at a shooting range. You have a .357 Magnum and your target is a metal bullseye. The instant you pull the trigger, the bullet fires out of the barrel at approximately 1,700 miles an hour. As it travels toward that metal target, the bullet is in a state of, and I'd like for you to remember this term, high velocity. High velocity means the sheer force of the momentum pushing the bullet forward is able to overpower the air resistance and the force of gravity that's trying to pull that same bullet down. Then, as it strikes the same metal target in the center, a perfect bullseye, the bullet loses all its momentum. And the force of gravity pulling it down is now able to overpower the bullet. So it instantly enters a free fall, plummeting to the ground. Now, remembering that analogy, take a look at this 13-month chart for the penny stock Grow Life, and I'll show you what it has in common with the bullet hitting that metal target. Grow Life is a tiny company that has become a big player in a controversial yet booming industry. It supplies everything from hydroponic equipment to lighting, nutrients, even marketing for the rapidly expanding medical marijuana industry. On this chart, we're going to focus on September 11th, 2013. That's when the green line shot straight up, right as the red line was falling. As they crossed paths, the first X pattern formed, right when the stock was trading for pennies, literally 3 cents a share. Now, think about that bullet traveling from the gun to the target. The first X pattern with Grow Life stock is equivalent to the exact moment the bullet leaves the barrel of the gun. It signaled that Grow Life had entered a state of high velocity. High velocity was achieved when the force of Grow Life's momentum, the green line, was stronger than the force of gravity, the red line, pulling it down. And over the next 7.5 months, nothing could stop Grow Life as the value of its stock experienced an immense burst, rising 1,080%. Now, it's not hard to imagine what could have caused this. After all, it was a top story during that October and November. Colorado and Washington both were beginning to accept license applications to sell medical marijuana, and the U.S. Justice Department publicly announced that they would not intervene in this formerly illegal industry in these two states. This opened up the floodgates for a new legion of customers, all clamoring for Grow Life's products. And thanks to this increasing popularity, during a late 2013 announcement, the company revealed its earnings had jumped 278% over the prior year. But none of that matters, because Grow Life stock had entered a state of high velocity before Colorado and Washington began accepting medical marijuana licenses, and before insider information about this company's financial successes became public knowledge. So anybody waiting around for the news would have missed out on a good bit of those 1,080% gains. And that's not all. Look at April 24th, 2014. The red line shot straight up as the green line fell. And there it is, the second X. Then, just like a bullet that has hit a metal target, the force of gravity overpowered the force of momentum. And shortly afterwards, Grow Life stock started to plunge, falling 86.6% in 28 days. And the reason why? It doesn't matter. Because without inside information about the stock, you would have had no idea it was about to fall down to earth ahead of time. However, there were two major signals, two major patterns that would have allowed you to pocket that 1,080% winner in 7.5 months. All you had to do was buy shares at the first X when Grow Life had entered a state of high velocity, then sold them when the second X appeared. This would have allowed you to transform a single $5,000 investment into $59,000 in only 7.5 months. But as interesting as this is, Grow Life wasn't even the biggest benefactor of high velocity in the medical marijuana industry. For Med Cannabis Pharma, that first X appeared on February 18, 2014. Its stock entered a state of high velocity, and it shot up 7,400% over the next 10 months before the second X was spotted on December 15th of that same year. This created an opportunity to turn a $5,000 stake into $375,000. The same simple rule of high velocity applied to Celgene, a biotech firm that focuses on cancer treatment. On July 2nd, 2003, the green line shot straight up as the red line fell. And just like a bullet, as it first exits the barrel of the gun, that first X signaled Celgene had entered a state of high velocity. Then, after jumping 930% on April 30th, 2008, the second X appeared as the red line shot straight up and the green line fell. And just like a bullet falls after it hits its metal target, it wasn't long before Celgene's stock plummeted 30% in value. Again, the exact catalyst behind Celgene's rise and the reason it came crashing back down to earth do not matter, because by simply grabbing the stock at the first X and selling those shares when the second X appeared, that 930% windfall would have been yours. Look at Pier 1, September 21st, 2009. The first X appears, and Pier 1 entered a state of high velocity. Then the second X appeared on December 24th, 2013, Christmas Eve, after the stock had risen 475%. And right after the holiday season, its share price fell, losing 45% of its value. So put them all together: Grow Life, Med Cannabis Pharma, Celgene, Pier 1, World Wrestling Entertainment, Netflix, American Vanguard. These are just a few instances of hundreds that have taken place over the last 15 years, and they all share the same rule in common. Well, nothing in the market is 100% certain. According to my immense collection of back-tested data on winning trades, by nailing this time frame, by simply buying shares when you saw the first X pattern and selling them when the second X appeared, you would have won on 100% of these trades. And through hindsight, you would have discovered that you averaged a 164.68% gain for each of these trades across the board. I'm so sure of this, we're putting $1,895,000 on the line. This is Monday Morning's boldest initiative ever. I'm going to explain all of that ahead. But first, we're going to discuss how you calculate those green and red lines I've been showing you. Then, I'm going to share the secret to finding companies where they'll cross to form these X's. And most importantly, I'm going to reveal two stocks where the first X just appeared, just now, so there isn't a lot of time left to act on them. The secret behind the X all comes down to a formula, and here it is. You take the number of periods for a stock, you subtract the number of periods since that stock hit its highest high, then you divide that number by the periods again, and finally you multiply that answer by 100. Now, I realize I just said a mouthful, but don't worry, there will not be an exam on this at the end of the presentation. However, it's important for you to at least understand the big picture. So I've highlighted two spots marked number of periods. That's simply the adjustable window of time the formula uses to determine the strength of both momentum and gravity. To keep things simple, let's use 100, meaning 100 days. We're looking to find the right time frame to base a specific trade on. Now, I've highlighted part of this formula labeled number of periods since highest high. What this represents is the number of days that have passed since this stock share price reached its 100-day high point for the green momentum line. Now for the red line, it's the same formula. You're just calculating the number of days since this stock share price reached its 100-day lowest low point. So after you crunch the numbers, you take these scores and you create trend lines for both the green and red lines. At 2 points, these two lines will meet, meaning both forces are equal. Then, at the first point, the green line will continue shooting straight up as the red line falls. The first X will appear. When they meet again, the red line will be the one rising as the green line is falling, creating a second X, just like you see here. These two X's generally signal a 48-hour window for when you should enter and exit a trade. For instance, what we're looking at here are the X patterns for railroad heavyweight CSX. On January 7, 2008, the green momentum line shot up as the red gravity line fell. They met when both achieved a strength score of 20. And just like a bullet, as it exits the barrel of a gun, CSX entered a state of high velocity. The stock shot up 45% over the next 8 months. Until on September 3rd, 2008, the tables turned. The red line shot up as the green line fell. They met when both equaled 30. Then, just like that bullet hitting that metal target, you can predict what happened next. CSX's stock plunged 53%. Fortunately, by following the X's in and out, you would have claimed that 45% winner. At first glance, this chart of Arena Pharmaceuticals appears to be a post-IPO catastrophe. It debuted at $25 a share in the year 2000, enjoyed a short-lived run-up, reaching the higher 40s. Then, it fell into a share price death spiral for over a decade. It hit rock bottom at $1.25 a share, 95% below its IPO price. So for many investors, Arena Pharmaceuticals are two words they never want to hear uttered out loud again. But the story would have been dramatically different if those investors knew how to spot this X pattern. December 2nd, 2011. The green line shot straight up as the red line fell. They met when both equaled 60. Then look what happened after the X pattern appeared. Arena Pharmaceuticals entered a state of high velocity, and the stock rose 250% over the next 11 months. Then on November 2nd, 2012, the red line shot straight up and the green line fell. They met at 10. Shortly after, they formed a second X pattern. And Arena Pharmaceutical stock fell by 50%. Fortunately, once again, the two X's would have saved your money from a similar fate and allowed you to pocket a 250% windfall instead. Look at the small construction firm Anderson's, ticker ANDE. Given its industry, Anderson's took an extra severe beating during the recession, crashing from $30 a share to only $7 a share. And for a long time after America's economic recovery began, the company's stock was still battling to hit a break-even point. But look at November 5th, 2012. The first X appeared. Anderson's then entered a state of high velocity. And over the next 17 months, its stock shot up 131% from $26 to $60 a share. Then, on April 3rd, 2014, the second X was spotted. And within 6 weeks, not surprisingly, Anderson's share price plummeted 23%. However, if you had just bought your shares when you saw the first X and sold when you spotted the second X, you probably would have never known that plunge had happened, because by then you would have grabbed that 131% payday and never looked back. Now, I'm going to tell you something that's extremely important, so please listen carefully. You've seen this simple X pattern countless times today. You've seen this simple formula that creates it, and it creates those simple green and red lines. So you might be wondering, how does something this simple elude the Buffetts and Soroses of the world and every investment bank and hedge fund for the last 15 years? Well, here's what you need to know. As incredible as this X pattern is on its own, it does not give us the ultimate answer. The X pattern in complete isolation does not predict with 100% certainty which stocks will enter into a state of high velocity. Consider that .357 Magnum at the shooting range again. Well, you can load many different rounds of bullets into that gun and fire them towards a metal target. That gun was designed for, as the name suggests, .357 caliber bullets. The X pattern operates in the same manner. It achieves optimal performance when it's matched with the right caliber stocks, high caliber stocks. When that first X appears in a high caliber stock, it quickly enters into a state of high velocity, unleashing an unstoppable explosion of profits before striking that bullseye. So, how do you determine if you are looking at a high caliber stock? Well, that requires another unique discovery that I made. And guess what? It's just as simple as the first. Frankly, I'm absolutely amazed that nobody has put these two discoveries together before I did, which is why I'm so very excited to be revealing my findings to you today. Because you're going to be able to capitalize on this before some of the world's most powerful investors can. By combining these two discoveries, you'll have the opportunity to, 1, pocket a non-stop series of windfalls that average out to gains of 164.68% each, and 2, with 100% certainty, only buy stocks that are going up. Now, here's the secret ingredient. It's called the F score. If you're not familiar with it, don't worry. Many legendary investment bankers, traders, all-star economists haven't heard of it either. And that's because the F score wasn't invented by some hotshot analyst at Goldman Sachs or Merrill Lynch. It was created by an accountant from the University of Chicago and Stanford. His name is Joseph Piotrowski, and his F score is an incredibly precise metric for uncovering public companies whose share prices are susceptible to enormous profit spikes. In other words, high caliber stocks. When determining the caliber of a stock's F-score, Piotrowski compares a company's current financial health to where it was the previous year by assigning 1 point for each of the following 9 financial milestones that have been reached: a rise in net income, a rise in operating cash flow, a rise in return on assets, a rise in working capital, a rise in gross margin, operating cash flow that is greater than the company's net income, its ratio of long-term debt to assets has fallen, its growth rate of sales exceeds that of asset acquisition, and last but not least, the company has not diluted the value of its stock by issuing more new shares to the public than it bought back. Now, let's imagine it's 1976 and you decide to take $1,000 out of the bank. With this money, you begin investing in stocks that have achieved an 8 caliber or greater F score. And what happened next is something you are really going to want to pay attention to. According to independent studies, for the next 20 years, that single $1,000 stake would have grown, on average, 23% a year. By 1996, it would have transformed your investment into $77,269.36. And as amazing as that 2-decade accomplishment was, the F-score is now even more accurate and more lucrative. Over the last 10 years, it has averaged a 26.7% annual return. So a $1,000 stake a decade ago would have grown into more than $10,666 today. Over the last 5 years, this performance is even better though. It's returned on average 33.9% a year. So if you started playing with F-score stocks with $1,000 then, today that same $1,000 would be worth more than $18,527. In fact, go back to 2008 for a second. This F-score would have single-handedly saved your portfolio from the recession. In 2008, the stock market experienced a 43% drop, yet F-score stocks rose 32.6% on average. With that kind of year-in and year-out market-beating performance, it is entirely logical to wonder, why isn't everybody using this? Pure hubris is the answer. Wall Street's top bankers and brokers refuse to believe that an accountant like Joseph Piotrowski can outpick them when it comes to stocks. If they did, his secret, his F-score, would not have remained buried in Piotrowski's hardly read 40-page report that never registered a whisper on the financial news programs or in the halls of trading firms. And it wouldn't have been me, a former member of the Wall Street fraternity, to be the first to discover this simple 3-step process. Step 1, identify those stocks that register an 8 caliber or greater F score. Step 2, buy these stocks when the first X pattern appears. And step 3, sell these same stocks when it appears again. For the last 15 years, by following this simple 3-step process, by nailing these X pattern timeframes, you would have hit a bullseye with all of these stocks, 100% of the short term, 100% of the midterm, and 100% of the long-term trades. And while the F-score on its own has averaged a 29.8% annual return from 1976 to 2014, the sheer force of the X pattern, all by itself, allows you to blow that number out of the water, like the 202% windfall over 3.5 months from Isramco Inc., the 63% winner in 6 months from Newfield Exploration, the 160% gain from Best Buy in under a year, the 126% winner from GameStop in 8 months, and the 470% gains from Tesla Motors in a little over 2 years. With Priceline, the distance between both X's was 2.5 years. The distance its share price rose during that time, 380%. These two X's rewarded investors with a 500% payday from Boston Scientific in 3 years. And after 6 years, they produced the opportunity to bank 1,430% gains from Middleby Corporation. Now, if the stock market has shown us anything over the years, it's that nothing is certain, and there are always risks involved. So I can't tell you moving forward this X pattern alone will produce winners 100% of the time. I won't tell you that the F-score alone, or by combining the X pattern with the F-score, will achieve this goal either. However, this is what I'm trying to make crystal clear. When you know which 2 to 3 stocks a month will display that first X pattern, when you can correctly predict this time frame, and you buy all the shares you can get your hands on, and then sell when that X appears again, you can be rewarded with a non-stop series of consistent and lucrative windfalls. And there's no end in sight. Take Asterias Biotherapeutics. There's that first X on March 3rd, 2015. Since then, the stock has gone up 200%. Facebook. after IPOing, delivered disappointment after disappointment. Then, on July 25th, 2013, the first X arrived. It has shot up 170% since then. Starbucks. That first X appeared way back on August 4th, 2009, when the stock was trading for only $8.60 a share. It's up 493% since then. Southwest Airlines. On September 10th, 2012, there's that first X. The stock was at $9 a share then. Today, it's 320% higher. Concordia Healthcare, up 1,033% since the first X appeared on December 27, 2013. Nobilis Health, its stock has risen 433% since that first X was spotted on November 7, 2014. And Bluebird Bio has shot up 325% since the first X appeared on October 26, 2014. So how high can these companies go? We'll have to wait until the second X to find out. That means each of these stocks should still have profits for the taking. So you could invest in any of them. However, I've got something much more lucrative in mind for you. The first X has just appeared in 2 new stocks, just now. That means you'll have an opportunity to get in right at the beginning of their run. Here's why I'm so sure of this. Here's why, as I'll explain ahead, I'm putting $1,895,000 on the line. This will bring us full circle. You may recall a few minutes ago I said that this X pattern will unlock a powerful secret that allows you to only buy stocks that are going up. Now think about every stock I've shown you to this point. Here are 9 of them in particular. Besides those X's, they all have another thing in common. These stocks were already going up. Look at Potash. The first X appeared and the stock entered a state of high velocity. By the time the second X appeared, shares had risen 500%. And with Holly Frontier, the first X was spotted on February 19, 2004. It took 3.5 years for the second X, but it was absolutely worth the wait because share prices for Holly Frontier had jumped 730%. Here's what I'd like for you to understand. We've all looked at stocks in the past that we wanted to buy, and we were ready to pull the trigger and grab shares, but we hesitated because these stocks were already going up. So we asked ourselves, did I just miss the boat? If you see that first X, the answer is a resounding no. You absolutely, positively did not miss the boat. The X only appears when stocks are already going up. But that's not the end of the ride, not by any stretch of the imagination. In fact, the real profit explosion is about to begin because these stocks are entering a state of high velocity. It's been the same story for the last 15 years with many penny stocks, with small cap, medium cap, even large cap stocks. These X's have delivered quick hit windfalls. Look at IsoRay, a small biotech firm with just 37 employees. Like many penny stocks, IsoRay's share price was experiencing a bumpy ride before that first X appeared on January 3, 2014, signaling it had entered a state of high velocity. Over the next 7 days, the stock doubled in price. Then it shot up 400% over the next 6 months, before the second X appeared on July 8, 2014. With Ovascience, its stock rose 366% in the 9 months between the first and second X patterns. And the share prices for Kelso Technology, a Canadian railway equipment supplier, rose 550% in 1 year. These X patterns have also produced long-term winners, like NetSuite. On August 16, 2010, the first X appeared, and NetSuite stock rose 385%. From $17.50 a share up to $85 a share for that second X on April 6, 2014. This same X pattern has appeared alongside the biggest windfalls of the last 15 years. Monster Beverage Corp, 7,438%. King Gold Jewelry, 3,650%. Dynamic Materials, 1,664%. Balchem Corp, 1,581%. And Keurig, 1,471%. And today, I'm going public with my findings because I'm launching a bold new initiative. It's called High Velocity Windfalls. It's beginning immediately. We're not going to waste another moment. And you are invited to take part in this very exclusive venture. I say exclusive because of the over 7.5 million readers and paid subscribers who turn to Money Morning's websites each month for financial guidance. I am only able to accept 5,000 of those who are receiving this invitation today. I don't know if I'll be able to open up to more spots down the road. Ahead, I'll explain why we have to keep our ranks so small, and I'll reveal why I'm betting $1,895,000 on this X pattern's ability to make you wealthier than you ever imagined. But first, you need to determine if high velocity windfalls is right for you. And here's how we can figure that out. If you were looking to get the most out of this, I believe you should be able to answer yes to the following 4 questions. High velocity windfalls question number 1. Are you willing to spend 9 minutes a week investing outside your comfort zone? This unique research and trading venture does not involve risky and complex leverage instruments such as options and futures. We will only be buying and selling normal stocks. That's it. And to find these lucrative opportunities, we will implement the simple 3-step process I described earlier. Step 1, we will target stocks that have fulfilled at least 8 of the 9 F-score milestones on your screen now. Step 2, when one of these stocks displays that first X pattern, I will recommend you buy it. And finally, step 3, when this X pattern appears again, I will recommend that you sell that stock. It's that easy. We will be in some of these opportunities for months, some for over a year. In fact, after investigating 15 years of winning trades, I've determined that this 3-step process has produced an average gain of 164.68% per trade, and the average window for each trade is approximately 16 months. Now, I realize that implementing a method like this may fall outside many folks' comfort zones, so I've simplified everything for you. I will provide you with all the research, specific trade recommendations, and even the training needed to capitalize on this X pattern. And since you are just trading stocks, you do not need any special accounts to take advantage of these exciting investment opportunities. You can use a stockbroker if you choose. You can also use a basic account from Scottrade, E-Trade, TD Ameritrade, or any of the other online brokers. So let's get into the specifics. I built a custom program that screens all publicly traded companies for those that have achieved an A caliber or greater F score. My team and I then verify these findings and release them to members. This is called the High Velocity Windfalls Watch List, and you will have access to it around the clock. It will generally have 10 to 13 stocks on it at a given time. Now, once a month, I will send you an alert via email after I detect this X pattern with a stock that is on our watch list. It will contain straight to the point instructions, so you have the opportunity to take immediate action. I will tell you the exact stock we're targeting. For demonstration purposes, let's imagine it's October 25th, 2011, and you've just received an alert to buy shares of Tricora Resources. Right here you can see that I'm providing you with an entry price range. I'm also recommending a specific amount of your portfolio that you allocate to this trade. And I've prepared a brief overview of the company. Next, we'll focus on Tricora's F-score. From what I've highlighted on your screen, you can see that we have a perfect 9 caliber stock locked and loaded. Now take a look at the chart for Tricora. As you'll see right here, there's the first X pattern. From the chart, you can also confirm the stock indeed has already been going up. And you know what that means. Tricora has entered a state of high velocity. The alert then includes step-by-step instructions for executing the trade. And from there, you're off to the races. Then, when that second X pattern appears, we'll repeat this simple process. You'll receive another alert from me. It'll look a lot like the first, only this time I'll be recommending that you sell your stake in this company. With Tricora Resources, that would have allowed you to capture a 116% gain. You'll know it's the right time because I'll share the full chart. And it's a beauty. Right after that first X, Tricora Resources spiked straight up. Then there's the second X. Now at this point, we're exiting the trade. Why? Because we will be taking a disciplined approach. We will not be gambling that this stock has another day or even a week left on its run. We're going to take our 116% winner in 10 months, cash out, and move on to the next opportunity. As you can see, high velocity windfalls is an extremely simple way for you to put a lot of money in your pocket, and it puts you in control of it. However, and I can't stress this enough, when you receive a trade alert to buy shares in a new stock or sell your stake in one of our existing recommendations, it's best to act within 24 to 48 hours. Which is why I've also had my team create a text message alert system. That way I can alert your cell phone along with your email that a trade recommendation has been issued. To be clear, you don't have to use this feature, but I'm making it available to help ensure that you receive this intelligence as soon as possible. These trade alerts are just the beginning of what you will receive with this venture. You will also be able to access an exclusive members website. Here you can tap into a large collection of investment tools and resources. My favorite of these is a 24/7 performance tracker. It will show you in real time how each of our positions are progressing and how much money you are making from them. So now let's talk about high velocity windfalls question number 2. Are you ultra motivated? If you simply want to follow the monthly trade recommendations, you can do that. And you can make a lot of money from doing just that. However, I'm also going to provide you with tools you need to hunt for additional opportunities. After all, this X pattern has been appearing alongside 2 to 3 stocks a month for the last 15 years. And remember, you will have access to the high velocity windfalls watch list. It will reveal the companies where an X pattern could appear next. So if you are an ultra motivated individual and you want to grow even wealthier from this venture by learning how to detect this X pattern on your own, then you are positively going to love what I want to talk about now. Moments after you receive this invitation, you will receive the High Velocity Windfalls Blueprint for Success. This is a simple to follow guide for investment do-it-yourselfers. In it, I'll explain the secrets behind the X pattern, portfolio allocation tips, and the actions you need to take now to hunt for these massive paydays. And next, you'll receive a very exciting and very lucrative resource that will put you in the center of the action, the High Velocity Windfalls Digital Boot Camp. Every week for your first 4 weeks on board, I will send you a pair of training videos. They will transform you into an expert on spotting this X pattern in large, medium, and small cap stocks from all sectors. I'm going to completely pull back the curtain here. I'm going to use these interactive training sessions to hone your skills with real case studies on lucrative stock trades. That way, in no time whatsoever, you'll be uncovering another series of massive paydays on your own. So when an opportunity to make 1,010% in 16 months comes around, like what happened with Global Star, you could be right there. Okay, we've talked about how we'll be finding and executing these trades. We've covered the training you'll be provided. Now, I want to ask you High Velocity Windfalls question number 3. Are you able to dedicate the resources necessary to make this work for you? Because we're only targeting stocks, it does not require a great deal of capital to take part in this venture. However, I strongly recommend a portfolio of at least $10,000 in order to get the most out of this. Here's why. It's impossible to know how long we'll be in any specific trade recommendation. I just know that for the last 15 years, these winners have averaged a 164.68% return each over 16 months. With Conversant Inc., the 2X's appeared within a span of 71 days, and that produced a 34% return. For Chipotle, it was 56% over 63 days. InterDigital stock went up by 500% in 6 months. With Multimedia Games, it was 173% in 8 months. And with Industrial Services, the time between the first and second X was 13 months. The reward, a 1,056% windfall. So many of our opportunities will fall into the short and midterm range, but not all of them. There will be instances with high velocity windfalls where we could quite literally hold certain investments for years. Take Cummins Inc. On April 18, 2009, the first X was spotted. 2 years later, on April 10, 2011, the second X appeared. In between, the stock went up 257%. For Schnitzer Steel, share prices surged 419% in roughly 2.5 years. For Raven Industries, it took 6 years. But when that means a 1,100% winner, I think that's a worthwhile trade-off, don't you? So when you combine the short, medium, and long-term holdings, this means at any given time, we could have 6 or 7 open positions, which is why I suggest having a minimum of $10,000 to start. You can absolutely have more if you want,